Welcome to the NAIFA webinar series, providing you with timely information and training each month on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today we are presenting Understanding Living Benefits in Life Insurance. With me today is Mike Smith. Mike is President of CPS Horizon Financial, an insurance brokerage firm, and Mike is the current chair of the NAIFA Member Benefits Committee. Mike's clientele include financial advisors, accountants, insurance advisors, and attorneys. CPS Horizon represents 36 carriers and helps advisors with life, disability insurance, long-term care, annuities, impaired risk cases, and living benefits. Prior to purchasing CPS Horizon, Mike was in personal production, qualifying for life membership in MDRT, including Core to the Table. Mike has presented sales ideas, marketing programs, and information on current insurance and investment trends to the $1 Million Roundtable, the Financial Planning Association, the Society of Financial Service Professionals, and 5 times at the NAIFA Annual Meeting and Career Conference. Mike was also on the board of the Green Bay Packers Hall of Fame. During today's webinar, you will learn how to navigate the complex living benefits terrain. Mike will explain in detail the different types of riders, including long-term care insurance, critical illness insurance, and terminal illness insurance. Mike will also prepare you to educate your clients on the need for living benefits through his proven sales and marketing strategies. You may type your questions in the question box on the right side of your screen at any time. Questions will be answered at the end of the webinar during the question and answer session. So let's begin. Mike, I'll turn the discussion to you.
Thank you very much, and good afternoon, everybody. Appreciate everybody getting on board here and taking some time out of their day to learn a little bit more about life insurance or living benefits. Much has changed over the last several years when it comes to life insurance, and we're going to take a look at all the different riders and features and benefits that living benefits, also known as accelerated benefit riders, offer. So next slide, please. Okay, so some of this stuff I have is going to be very basic, and we're going to blow through some of these slides really quick, and then some of them we're going to spend a little more time on. So this is designed for continuing education credits in a number of different states. So some of these things, like this first slide here, we know why a lot of people object to even purchasing life insurance. They fail to face their own mortality, they think it's too confusing, they just don't want to face it and don't believe in life insurance. But let's take a look at some of the other types of insurance that are out there and take a look at some of the objections and how we can turn those objections into positives and produce opportunities for sales. So go to the next slide, please. Long-term care. Why do people fail to purchase long-term care? For many different reasons. They think it's too expensive. They think it's too confusing. The premium increases during the policy years. Over the last few years, we've seen in premium increases of 15, 20, 40%, even 80% increases on in-force policies. And the consumer is never happy when they see that happen. There's also been some instability of the market, carriers getting in and out of the marketplace. And of course, the old objection, what if I die without using it? Next slide. What about critical illness insurance? Now, this has actually started to pick up. Sales of critical illness insurance have picked up, and many people, many of the general consumers, and you listening, are aware of critical illness insurance, but you don't realize it. First of all, most consumers don't know about long-term care insurance, critical illness insurance, and many agents don't even know about it. A lot of consumers think the health insurance covers the little critical illnesses. They think it's too expensive. And what if I don't get the illnesses covered by the policy? Yet, if you think about it here, critical illness is really quite accepted by the general public. They just don't, it's not called that. So every time you see a commercial on with a quacking duck, one of the things they're talking about is critical illness insurance, including also disability insurance. So there's critical illness and mention the commercial with the quacking duck, people are going to say, oh yeah, I didn't even realize that. Next slide. So one of the things we're going to be talking about, or the main thing we're going to be talking about, is all these life insurance companies that have now kind of got riders built into their contracts or options to provide for critical illness, long-term care services, of course, terminal illness. Now, the terminal illness rider, that's really nothing new. That has been around for a long time. They're also known as accelerated benefit riders. So should the insured be deemed with terminal illness for either 6 months or less or 12 months or less to live, they can tap into their life insurance death benefit tax-free, often in lump sums, while they're still alive. What's newer are the long-term care services. We'll talk about that in detail. And also what's very new is the critical illnesses that are being built into the life insurance contracts or offered as an additional rider. Move on, please. So a couple statistics that we all know about. 70% of all Americans will require some kind of chronic/long-term care. We've seen that statistic come out more and more often. 90% of those requiring chronic care will not have the insurance to cover it. Not enough people are buying long-term care insurance. When it comes to other health issues, the age of a first-time heart attack is 66. By 65, most of us will have an incident of heart disease, cancer, or stroke. And 75% of bankruptcy filings are for medical reasons for people who had health insurance. So obviously even though you may have health insurance, whether it's through your company on your own, through the ACA, there's still a lot of bankruptcies being caused by medical reasons. Next slide. So what are the chances of needing long-term care? 70% chance. You're going to see that in the 2015 Medicare handbook, that statistics have said that 70% of us are going to need some kind of long-term care. So in reality, it's either is it for one individual or both for a couple, or what is it? People often think that, I've seen statistics that between a husband and wife, there's a 70% chance one of the two of them are going to need long-term care services. I've even seen that as high as 85%. All depends upon where your statistics are. The point, obviously, is that the chances of needing some sort of long-term care, either at home, assisted living, or nursing home care, are quite high. Next slide. So how is long-term care generally paid for? Well, it's lifestyle. It's the cost of potential life, well-being, and the earning ability of a spouse or the other loved one. My father had a stroke at age 58, 59 years old. He never went back to work. My mom continued to work until, actually she's still working right now, but my dad lived 9 years after his stroke and needed care at the home. My mom still needed to work and provide health insurance and some other income and things. And that affected their lifestyle, obviously. Of course, there's income. You end up paying dollar for dollar for your care, or you can get insurance. Now, we're not really going to go into too much of traditional long-term care insurance. That's for other people or other slides, other programs. We're going to talk about how to use life insurance or annuities with long-term care insurance or benefits attached. So next slide. So bottom line, now life insurance can have not only the death benefit, there's a terminal illness rider, there's a chronic illness rider, which is also known as a long-term care rider, and I will shortly go into details and explain the difference between a long-term care rider and a chronic illness rider, a critical illness rider, and it's all in one plan. So next slide. All right, so here are the ways you can do it. We've kind of harped on this a little bit. I wanted to make sure that there was another way that people can look at this and, utilize what makes some sense for life insurance with long-term care riders or traditional long-term care insurance riders. Long-term care riders and life insurance, look at the middle there. It's not necessarily the most customizable. You can still have the full death benefit and take money from the death benefit on a monthly basis or an annual basis to pay for long-term care expenses and reducing the death benefit. And then there's also something called link benefits, which is kind of a single premium type of a contract. We're going to go into a little bit of both and describe both and point out points, pluses and minuses and differences between all of them. So next slide. All right. Now, we're about to dive in a little bit deep here, and I want to make sure that if you're taking notes here, that you're kind of understanding the terminology. Some of these contracts are called hybrids or combinations. Some are called accelerated death benefits or accelerated benefits. Some are called living benefits. If you are talking to your customer, your consumer, and you say, my product has accelerated benefits, they're going to look at you like a deer in headlights and not understand what you mean. using the terms hybrid or living benefits, those are the type of things that the consumer is going to understand a little bit. So for our purposes here, a hybrid or a combination plan is a life insurance policy with an optional long-term care rider, or it has the rider built in, and I will go into the differences. Linked benefits are life insurance or annuities with long-term care features. And then life insurance with living benefits, not only could it have a long-term care feature, but it will have a critical illness rider as well. So we're going to go into depth right now. So moving forward. All right, so life insurance with a long-term care rider. These are typically traditional whole life or universal life contracts. Some companies have it as an optional long-term care or chronic rider. Some of them have it where it's automatically built in. The triggers for the riders are similar to traditional long-term care policies, that whereas you cannot perform 2 of the 6 activities of daily living without substantial assistance. I added that last phrase on there because it's important, without substantial assistance. So maybe somebody can perform the 2 of the activities of daily living but needs standby assistance. That's not going to qualify for a claim, nor will it qualify for a claim on most traditional long-term care policies. Most of the contracts say without substantial assistance. So you're going to want to take a look at making sure that the definition of substantial is well defined. The other triggering event is a cognitive impairment, such as Alzheimer's or dementia. When it's a rider built in or as an option to the long-term to the life insurance policy, you typically have access to 1, 2, or 4% of the death benefit each month for long-term care services. So if you have a $300,000 life insurance policy and it has a 2% long-term care rider, that's going to provide $6,000 a month until the $300,000 is gone, and that's for 50 months. So I know some companies say you have access to 24%, and that's paid out monthly or it's lump sum. But most of the companies that are out there that are coming out with plans are saying you have access to 1, 2, or 4%, with most plans that we see being chosen for 2% on face amounts of $300,000 or more, or 4% on smaller face amounts like $200,000 or $100,000, just so it gives a little bit more bang for the buck for monthly benefit. So we'll go to the next slide. The great thing about this is if you go on claim, the benefits are tax-free because it's coming from the death benefit. Now, I want to take a second here. The next bullet point says, if chronic, no health license or additional CE required. I'm going to take a second here to describe some of the differences between a long-term care rider and a chronic illness rider. Some companies have their rider filed as a true long-term care rider. Those companies are going to require that the agent have a health license and have long-term care certification education. So additional CE. If it's a chronic rider, no health license is needed, nor is there long-term care certification required. Most companies have come out with a chronic illness rider instead of a true long-term care. The trigger events for the chronic are very close to the same thing if you cannot perform 2 of the activities of daily living without a substantial assistance or a cognitive impairment. But it is very possible with a chronic rider, to have the inability to perform 2 activities and still be denied a claim. So I'm going to share an example, and I want you guys can steal it and whatever you want with it here. Let's say you're hanging holiday lights or cleaning out the gutters, and you're up on a ladder, and you fall off the ladder, and you break a bunch of bones, and now you're sitting here in a body cast. You cannot perform 2 of the activities of daily living. So you say, hey, I'm going to tap into my life insurance policy with that chronic rider and make a claim. There's a very strong probability you're going to be denied the claim because your condition is expected to get better. You're expected to be able to heal and get out of that body cast and resume a normal life. Because that condition is expected to get better, it is not considered chronic. Therefore, you will probably be denied a claim on a chronic rider. If it's a long-term care rider, the only thing you have to make sure you get past is the elimination period, which in most cases is 90 days. So I want to make sure that you realize that it is possible for the chronic rider to be denied a benefit if you have the inability to perform two of the activities of daily living. Why are companies coming out with chronic riders more than traditional long-term care? Two reasons, in my opinion. One is for just what I mentioned about the claim. It's a little bit easier. There's a little bit of a loophole there when it comes to a claim. But two, marketing and sales. You do not have to have a health license or the long-term care CE to sell the chronic rider. So therefore, it opens up other advisors across multiple disciplines who can recommend or sell the chronic rider. Moving on to the next bullet point there, it says some riders, go back, there we go. Some riders are indemnity and some are reimbursement. Reimbursement, as you know, is typically submitting receipts and getting reimbursed. Indemnity is if you apply for $6,000 for the month, $6,000 with a benefit, that's what you're going to get. We'll go into a little bit more of that in a minute. And then some companies allow for family members to and informal care to be allowed. So it all depends upon what company has what for riders. Other companies, in fact, most companies say that if you are receiving care, it needs to be by a licensed practitioner, or a nurse, or a facility, or something along those lines. And we'll go into that a little bit later. The cost of long-term care rider is not bad if it's an optional rider. For right there on the bottom of your screen, if it's a male age 58 for a $300,000 policy issued standard, it might be $5,300 for the universal life without the rider. But if you want to add the long-term care or chronic rider, it only adds about $300 a year to the premium, so $5,600. For a female age 65, you're looking at from $6,225 to about $6,600. So cost of the rider is not bad at all. All right, let's move on to the next slide. When it comes to life insurance with a long-term care or chronic rider, premiums can be single or ongoing. You can do a 1035 exchange from other policies. In fact, we've seen a lot of that over the last several years with people getting out of underfunded ULs or variable universal life that they just don't really need the cash anymore. 1035 exchanging the cash value into a policy that has a long-term care rider and even eliminating premiums or keeping premiums relatively the same, adding the additional benefit of having a long-term care rider under their life insurance policy. If somebody goes on claim, any unused death benefit is paid to the beneficiary. So if you have a $300,000 policy, you pull out $200,000 for long-term care needs and then pass away, there's still death benefit left over for the family. But however, once the death benefit is fully used for long-term care needs, typically the policy ends. So if you use up that $300,000 for long-term care and then pass away, most carriers do not have a residual death benefit. There are some that do, but most of the time you see where if you use up the $300,000 for long-term care, the policy ends. And most of these contracts I've seen issued up to age 80. Okay, next slide. So who's an ideal client? We're finding people ages 45 and older who are concerned about long-term care and may have objections about traditional long-term care policies. And, you know, some of the objections are right there on the screen there. And often clients want to have more value from their life insurance. So when the advisor points out to them, and that, you know, when they're working with their clients about obtaining some life insurance, we often suggest, hey, why don't we add the long-term care rider and see if your client has interest in being able to have a little more value from the life insurance. And the advisors we work with say, all right, let's take a look at that. Show me an illustration with and without the long-term care rider, and be absolutely amazed at how many applications come in with the rider because the clients just think, wow, that's really a nice feature. Okay, next slide. All right, now what we're going to go into is the linked benefits. So everything I talked to you about before was life insurance with a long-term care rider. Now we're going to talk about linked benefits. Now this is similar, but these are typically going to be single premium contracts. So you might take a $100,000 death benefit, and instead of having just $100,000 for long-term care, there's an additional pool of money over and above the death benefit that can be used for long-term care. It's another way to design life insurance or an annuity with a long-term care pool of money. So next slide. So what are link benefits? Typically we're seeing these be single premium products. A single premium lump sum, money coming from a CD, annuities, maybe somebody just having money in money markets or selling some stock or whatever. But most of the time we're seeing these be single premium contracts. There are a few out there that allow for ongoing premiums. I see these on annuities. I see these pretty much on fixed annuities, universal life and whole life. And what you're basically doing here is better leveraging those assets to include either a higher death benefit and a big pool for long-term care benefits. This can be done with most often with non-qualified funds, but there are a couple of companies that allow for qualified funds to be transferred into a linked benefit that will provide tax-free long-term care benefits. However, none of these are partnership approved, long-term care partnership approved. If you don't know what that means, I would advise going on the NAIFA website and looking up some literature on that. Go to the library that NAIFA has and take a look at partnership contracts and learn a lot about those, because that's a whole other topic in itself. All right, next slide. So how do they work? And what they basically do is create tax-advantaged withdrawals from annuities and life insurance to reimburse or to pay for long-term care events. I've seen it where you can double, triple, or create a lifetime of unlimited benefits. So we've got some carriers, for example. Let's talk about an annuity example here. Wherever the account value is, whatever the account value is, you triple it, and that's what's available for long-term care. So someone does a $100,000 deposit into an annuity or a 1035 exchange of $100,000. Their account value is going to grow by whatever the interest rate is. But if they need long-term care services, you triple the account value, and that's what they have for long-term care. So $100,000 turns into $300,000 for long-term care purposes. Now, when you go on claim, when the client goes on claim, they're going to withdraw from the accumulation or the death benefit, if it's life insurance based, first, and then once the accumulation or the account value or the death benefit is used up, that's when the extended pool of money or the additional pool of money for long-term care kicks in. And we'll go into a little detail on that. Next slide. So again, going on claim, you have similar triggers to traditional long-term care policies, two activities of daily living without substantial assistance. I want to take a second to discuss this because we have one of the brokers we work with here, he had sold an annuity with a long-term care rider to his father-in-law. And his father-in-law went into a assisted living / nursing home and was denied a claim. And I really want to harp on this in depth here because I want to make sure everybody understands. The facility had several different levels of care. They called it level 1, 2, 3, and 4. The family didn't know what kind of level Dad needed, so they said, let's start him off at level 1 care for a couple of months and see how that goes. And if he needs, and that's a little cheaper. That's a little cheaper amount of payment to the facility. And if he needs more extended care, then we'll go into levels 2 and 3 and so on down the line. Level 1 care was really not substantial assistance. It was really providing standby assistance. So therefore, the insurance company denied the claim initially because the care was that was being provided was standby assistance, not substantial. It took a couple of months before the family was able to figure out that, okay, yes, he really needs more care than just standby. And then so they moved him to like level 2 type care, which was considered substantial, and then the insurance company covered the claim. So it's important to realize, because a lot of the marketing materials out there, when they talk about how to go on claim, leave out the phrase without substantial assistance. It says, you cannot perform 2 of the activities of daily living. They just leave it at that. Without substantial assistance is critical, and that you're sharing that with your clients, or without a severe cognitive impairment. Again, you're tapping into the death benefit of the annuity, or the death benefit for life insurance, or the annuity accumulation value first, and then the rider kicks in and provides an additional pool of money. The cool thing about this is all the benefits that they're being used for long-term care purposes, whether it's the account value or the death benefit or the additional pool of money, is all tax-free. And that's because of the Pension Protection Act of 2006. All right, so for the technical people out there wondering how that is. Next slide. All right, so some companies have reimbursement versus indemnity versus cash indemnity plans. I told you before we're going to go into a little bit more detail on the differences between reimbursement versus indemnity. Some companies allow for formal caregivers and some for informal caregivers. So what's an informal caregiver? Generally, it's a caregiver that is not licensed or certified, and it can often be a family member or sometimes a friend or neighbor. So let's go to the next slide. Obviously, a formal caregiver, just you can stay on this slide. Obviously, a formal caregiver is the a licensed practitioner or a nurse or a certified CNA or a facility or something along those lines. Now let's talk about reimbursement plans, and we're going to talk about the differences between reimbursement and indemnity. We've gotten quite a few questions over that to make sure people understand the differences. What you probably already know, reimbursement usually requires monthly submissions of bills and receipts to the insurance company, who will then reimburse the insured or the owner of the policy. What people don't realize is that most of the companies have kind of a, if you go on claim and it's reimbursement type, they'll have a care coordinator assigned to the claim and will work often directly with the facility to have the facility submit the bills directly to the insurance company, who can pay the bills instead. So there's a lot, that's actually becoming the norm with many carriers. So instead of having to submit bills and submit receipts and all that, have the insurance company work directly with the facility or the agency, like the nursing home agency or the home health agency, and work directly on that. But what you may not know, if you take a look at the bottom half of the slide, is that only reimbursed are approved services. So you want to make sure that whatever services the people are receiving are reimbursable. Some contracts do not cover or have limitation on transportation costs. So if somebody wants to have a special van or something along those lines, that's going to be important. Will that or will not be covered? A lot of reimbursement plans may not cover something like that. And generally, places have limits on home modifications. So there might be some, do you want to put ramps or grab bars, those type of things? Reimbursement plans may not cover that. That's where you may want to take a look at a plan that does. So let's go to the next slide. And indemnity plans. As you know, the indemnity plans, if you sign up for $6,000 a month, that's what you're going to get. It pays the full monthly long-term care benefit to the policy owner, pays in full even when collecting from other policies. Reimbursement plans might not do that. And there's no monthly bills or receipts to submit. What you may not know is that there's lots of times there's not a lot of restrictions on the service. Some might require a licensed provider, but some may allow for family members. So if you're a daughter or daughter-in-law, I'm going to be incredibly stereotypical in this, but lots of care that is provided in home is, whether it be a daughter, daughter-in-law, or a sister or something along those lines. An indemnity plan may allow for that, and so if your client's disabled or needs long-term care services like this, and there's a family member that's taken off a time for work, this is a way that maybe you can use those benefits to help pay for that provider, even if it's a family member. Okay, but there's more than one type of indemnity plan. Let's go to the next slide, and we'll kind of go into what a cash indemnity plan is. And there's not a lot of companies for this that offer this, but again, there's very little or no restrictions in services. You can use informal caregivers, even family members. You can put it into an irrevocable life insurance trust, and that's kind of a nice feature that's not always available. I don't think it's available at all with reimbursement plans. And with traditional indemnity plans, it's kind of iffy whether it would work with an irrevocable life insurance trust. Cash indemnity plans, you can use an irrevocable life insurance trust, which I think is pretty helpful when it comes to the overall estate planning. And there's a couple of things on the slide here. There's no HIPAA cap, and there's no approvals needed from the insurance company to help pay for home modification, to pay for transportation costs, or obtain like a special van or something along those lines. They can use excess benefits for basically anything else. So that was the difference between reimbursement, indemnity, and cash indemnity plans. And multiple companies have different versions of their offerings. And it's important to know that some companies have reimbursement, some have the indemnity, and so on. Let's go to the next slide. So let's do a little comparison here. There are many companies now that have either been in the marketplace for a long time or are starting to come out with more and more linked benefits or life insurance or long-term care riders. This is a NAIF event. We're not going to be mentioning any companies by name. So I just put 3 companies up here, and then what I've got here is a 60-year-old woman in Standard Health that she's going to put in a single premium lump sum into a life insurance-based linked benefit. And you can see that the face amount of the life insurance kind of varies. If you take a look at the far right-hand side, the company Good Things to Life, their product TLC, you might, that $100,000 would get her $172,000 of life insurance. Now, if she were going to go on claim for long-term care, that would provide $7,200 a month for 6 years. So if you do the math, 7,200 times 6 years, that provides her $518,000 of benefit. Her $100,000 single premium gets her $172,000 with a death benefit, but if she needs long-term care services, there could be over $518,000 available for long-term care benefits, all tax-free. And all these carriers have some kind of return of premium. It used to be you could ask for, if you change your mind, the client changes their mind 2 weeks, 2 months, 2 years later, or whatever, you can get 100% of your premium back. We're finding that some carriers have done some modifications to still allow a return of the premium, but now they've added a few years to it. Maybe you have to wait 3 years or 5 years or something along those lines. So the purpose of this slide is seeing that there's a tremendous amount of value that you can use for these linked benefits on the life insurance side, and you can do a wide variety of different planning techniques. You want more life insurance or death or long. Look at the the left-hand column. The death benefits are roughly 150. The long-term care benefits 149,000. So it's a mix of trying to figure out what's more important for the client. Is it more life insurance or is it more long-term care? And everybody, all companies will allow for some customization around what your client's needs are. Next slide. This slide is an annuity-based. So it's the same female, age 60, putting in $100,000. But instead of it being life insurance-based, which is going to have a lump, a benefit, this is an annuity-based. Now, I feel that if this is money coming from an existing annuity or something along those lines, where once it's an annuity, you kind of always have to have an annuity unless there's tax ramifications. Here we take a look at a couple of companies here, and this woman puts in $100,000, and if you take a look at annuity value year 1, so just on the left side of the page, annuity value year 1, after 1 year, her account value has grown to $101,548. Not exactly a good return. It's not designed for that. If you have clients that have annuities and their intention is to use the income from the annuity to supplement retirement, do not do a linked benefit with a long-term care rider, because it's just not what they're designed for. This is designed for the people who have annuities or have other lazy money that they really don't intend to touch unless it's there for emergencies. And if you're a 72-year-old person, what's the biggest emergency likely is going to be a health care issue. So what we're showing here is she puts in $100,000. After year 1, she's got $101,000, but the long-term care pool of money is $304,000. It's going to provide $4,231 a month for long-term care benefits until the $300,000 is gone. Now, I want to go back to what we talked about before. If you go on claim, what's happening here is you're taking the money from the annuity value first and then dipping into the pool of money. So looking at the company in the middle there, Forethinking Annuity, for example, if she goes on claim in the 10th year, her account value is $116,000. She's going to be pulling out $4,859 a month first until the $116,000 is gone. Once that is gone, and when she pulls out that $4,800, by the way, that's all tax-free. Once that $116,000 is gone, then the additional pool of money kicks in, the other $232,000, and that again comes out tax-free. Quick question I often get: what if she pulls out, $50,000 and then passes away? What's left over? Well, the difference between $116,000 minus the $50,000 is $66,000. she would still have $66,000 that's paid out to her beneficiaries, just like in a normal annuity does. All right, so here's a couple, like I said, there's a couple of examples of some different companies and how they design their annuity-based long-term care riders for linked benefits. All right, next slide. So just a really quick summary on this. The combination, which is what we talked about before we got into the slide about linked benefits, the combination life with a long-term care or chronic illness rider, those are typically whole life or universal life. It's typically ongoing premiums. Normally the rider is an optional rider. There are some companies that have it the rider automatically built in, but normally it's an optional rider. You have access to the death benefit in 1 to 4% increments each month. And when the policy used up for long-term care, typically the policy ends. The linked benefits are annuities or life insurance. I've seen it on whole life or universal life. Typically it's single premium as opposed to ongoing, and we're finding about $50,000 or more in a single premium to make it somewhat worthwhile. The long-term care benefits are built in, and when you go on claim, it's access to the death benefit or the annuity value first, and then an additional pool of money. So both are very viable options to providing some kind of living benefit with either life insurance or annuities. Again, if the benefits are used for long-term care purposes, it's all tax-free. Okay? There's a slide you want to take a picture of or make notes of. This is it right here. That really helps describe the differences a bit. Next slide. So now we're going to talk about life insurance with a critical illness rider. So this is, again, another version of access to the death benefit alive, but if someone suffers a critical illness, such as a heart attack, cancer scare, stroke, or ALS. So we'll go on to the next slide. So again, a couple more statistics here. Odds of death before age 65 for a 25-year-old male are 19%. But that same male has a 24% chance to be struck with cancer, heart attack, stroke, or before the age of 65. And odds increased almost 50% if they're a smoker. Again, like we talked about before, 62% of personal bankruptcies are due to health issues, and many of those had health insurance. Next slide. A couple more things for strokes. Every 40 seconds, someone in the USA has a stroke. It's the third leading cause of death, but often leads to serious long-term disability. Like I mentioned before, my dad had a stroke and lived another 9 years before he passed away. Heart attacks, every year more than 1 million people suffer a heart attack. They survive for 12 months, but 3/4 of all male first-time heart attack victims survive between the ages of 35 and 55, survive for at least 5 years. And cancer, more than half of Americans diagnosed with cancer will survive at least 5 years. All this is saying that medical technology has advanced, where a lot of times we're able to survive some of these things, but now we've got some kind of a chronic or a critical illness. Next slide. So what the critical illness rider does is, again, it provides for the advance of the death benefit if the insured experiences a qualifying critical illness. I've seen carriers have as few as 5, and I've seen it to as many as 16 different critical illnesses covered. And so these are some of them: stroke, ALS, heart disease, heart attack, invasive cancer, AIDS, severe disease of an organ. Some of them, blindness, major organ transplant, central nervous system disorders. Those are all some things that some carriers offer as a critical illness rider. Some of these carriers offer the rider free. But most of the time what we're seeing, if somebody goes on claim, it's a small administrative charge to administrate the claim. Again, it should be tax-free if it's being used for a critical illness and it's coming from the death benefit. Next slide. So how it works, the more severe the trigger event, the more dollars that are available of the policy. I've seen carriers offer 100% of the death benefit available. I've seen carriers offer 90% of the death benefit, but it's capped at something here, like $500,000 is common. Some carriers would pay the remaining 10% at death, and then some people, if they take money while they're alive on claim, the policy could end. And it's important to realize that some companies, and really break down the nuances of what each carrier kind of does if your company offers it, if you're going to go out and explore these options a little more. go on to the next slide. We'll go into some more detail. So how much of the death benefit is available? So I'm going to ask a question you can answer to yourself, and then this will really kind of figure out. So say someone's got a $300,000 life insurance policy with a critical illness rider, and they suffer a cancer scare. And it's a good scare. I mean, it's stage 4. They're going to lose their hair, go through chemotherapy and things, but there's a decent chance they're going to live. How much of the $300,000 are they going to get? The truth is, I have no idea, and there's no way you know either. So the bottom half of this slide describes how it works. If someone goes on claim, the insurance company is going to obtain the medical records and then basically do a life expectancy calculation. They're going to say, all right, for a 42-year-old male with this kind of a cancer, or a 63-year-old female with this kind of heart condition, what is the life expectancy? And the shorter the life expectancy, the more money they're going to offer the insured. The longer the life expectancy, the smaller the offer. So let's go to the next slide. And here's another way to look at it here. If you're for the engineering type that's in the audience here, this is how they kind of, there's a formula they follow here. It's basically like a 7.5% discount, but a lot of it has to do with life expectancy plus loss of premium plus policy value with a discount. I'll go into a little bit more less technical answer on that in the next slide or two. So next slide. So how much is available? Again, the carrier will make an offer of the living benefit or the accelerated benefit. The client is always in control. The client can choose to accept or decline the offer. If they don't want the offer of the cash up front, they can decline it and the policy continues as normal. But if they accept it, policy could end or the policy could continue but will have a reduced death benefit. No matter what I've seen from company to company, anytime somebody chooses some cash from the death benefit, there's going to be some death benefit that's lost. The entire $300,000 is not going to be available. It's going to be somewhere south of that. But it's always the client has control to choose what they have and how much they can get. And we'll go through a couple more examples. So next slide. So here's an example. So Joe buys a policy. It's a $125,000 death benefit. His premium is, $306. 5 years later, he has a serious heart attack with a life expectancy of 16 years. That's still a long time. So what he wants to do is he says, okay, I want to keep $12,000 of death benefit in force, but I want to accelerate $112,000. So is he going to get $112,000? No, they're going to do the life expectancy calculation and then make him an offer. And the offer to him in this case was $43,000. So he could get that $43,000 tax-free lump sum, but the remaining $69,000 of death benefit is gone because he took the money. So bottom line here is he still has $12,500 of life insurance. The insurance company will adjust the premium for that, whatever the death benefit is, $12,000. But he wanted to accelerate $112,000, but they gave him $43,000. Is that a good deal? Is that a bad deal? It's the client's choice. If that $43,000 allows him to keep the roof over his head, the kids in college, and the medical bills paid or whatever, it's his choice if he wants to take the money. Here's another example. Let's go to the next slide. So here we've got a woman. She's got a $250,000 policy. 2 years later, after she gets it, she's in a serious car accident and now cannot perform the activities of daily living or something along those lines. Her life expectancy is only 2.5 years. She wants to, of her $250,000, she wants to keep $50,000 in force. And she says to the insurance company, I want to accelerate $200,000 of my policy. They offered her $175,000. So she got $175,000 tax-free lump sum. She still has $50,000 of death benefit remaining. But what she kind of gave up was the extra $25,000 of death benefit. Again, is it a good deal, bad deal? It's the client's choice. So that kind of gives you an example. The shorter the life expectancy, the more money that they're going to be able to get from the life insurance contract. Next slide. So here's another way to kind of show this here. If a male has got a $250,000 policy, he's 32 years old, how much is available? So at age 65, maybe he has a real slight heart attack. They offer him $76,000 of his $250,000. Not a lot. If it's a moderate heart attack, maybe they offer him $138,000. If it's severe, maybe they give him $200,000 of his $250,000 contract. If you take a look at age 85, the amounts are higher because now this is a permanent policy. The cash values have crossed the threshold on the corridor, so there's more cash value than there is death benefit. So maybe that death benefit when he's 85 might be $380,000, but they're going to be able to say, all right, here, if you're at this age, you have these kind of conditions, they might offer a higher amount available. Let's go to the next slide. The key here is don't overpromise. If it's a slight heart attack, slight impairment, slight critical illness, something along those lines, we're seeing anywhere from 15 to 30% of the death benefit available. If it's moderate, you're going to see offers coming in from 30 to 55%. And if it's a severe heart attack, cancer scare, whatever, you can see anywhere from 45 to actually 80% now. We saw one that was 80% available as an offer from the insurance company. Again, there's no way to predetermine how much is available. The benefit amount is determined when the trigger event happens and the severity of it. Next slide. So think about this. Now we're going to wrap this up pretty soon here with some marketing ideas and hopefully some ideas that you can take right to your book of business or your prospects. Everybody is selling and buying term insurance or maybe some permanent insurance, but maybe just at a minimum. If you're just sitting here saying, all right, maybe I just want to dip my toe in these things. Well, what about offering an additional universal life with a long-term care rider? Maybe just $100,000. So if somebody goes on claim, they have access to the $100,000 for long-term care benefits. I mean, again, I think traditional long-term care insurance is the best way to insure for long-term care needs, but again, there's a lot of people that have objections to it or may not qualify for it or just don't want to get it or for whatever reason. Something is better than nothing. So maybe I think $300,000 is a great starting point for long-term care. That's $6,000 a month. If you do $100,000, maybe you do a 4% rider, so that's $4,000 a month and until the $100,000 is gone. But you know, it's a way to offer your clients additional value for some life insurance. Let's go to the next slide. Now, here's something that's pretty cool, too. Some carriers have term insurance with the critical and long-term care riders built in. Some of them even have top 10 pricing. So this is where I catch a lot of people off guard. They often think that the long-term care or chronic illness riders, these are only available on permanent insurance. It's actually available on term insurance. There's a number of companies that have it available on term insurance. And let's go to the next slide. I think I've got some sample pricing of, here we go. Here are some comparing rates. Now this chart, let's take a look at the left-hand side. It's a male, age 32, issued preferred non-tobacco $500,000 term insurance policy. A 20-year term is $29.31, death benefit only. That DB stands for death benefit. So it's a traditional term, 20-year term. It's just death benefit. That monthly premium might be $29.31. However, for an extra, 50 cents, they can have something about a 20-year term with the living benefits built in. So that's got the critical illness rider, the chronic illness rider. Is it worth the extra 50 cents to have that flexibility? Same column, 30-year term, it's 30 cents difference. Let's kind of go to the middle there. A 55-year-old male issued standard non-tobacco for $300,000. We've actually seen it cheaper to get a term policy with living benefits than it is a traditional death benefit only contract. And then taking a look at, let's take a look at the female, age 65, standard non-tobacco, $300,000. A 10-year term, it's again a few pennies a month difference. You go to the 20-year in the bottom, it's $339 a month for a death benefit only, as opposed to $371 for a contract with living benefits. That LB does not stand for pounds. That could be if you're, it stands for living benefits. So a difference there, what is it, $30 a month, somewhere in that area. Is it worth the extra $30 a month to be able to have access to the death benefit while you're alive for home health, assisted living, nursing home, critical illness? Your clients are probably going to think, yeah, that's worth it. Let's go to the next slide. So kind of wrapping this up, and then we're going to hit it hot and heavy with some sales ideas here. Everybody knows that life insurance is not a lot of fun to talk about, but everybody knows somebody who's had a heart attack, cancer, stroke, or needs long-term care services, and you've seen some of the statistics of critical illness and things. Why not show people that life insurance has a lot more value than just death benefit? Let's go to the next slide. So I'd like to try to figure, why wouldn't you recommend something that has living benefits? And why wouldn't you buy one yourself? Let's go to the next slide. So now what do you do here? I've kind of gone through some of this, and what you do now is start calling your clients and schedule times to discuss with them. If your company offers living benefits, and maybe this webinar inspired you to take a look at some of your own company's products a little bit closer, or your company doesn't offer it, but you're allowed to go to other companies without violating your contract that you have, research the companies and concepts that have the living benefits. And then what you do is you call your clients. Here's a couple of power phrases. Dorothy, there's been a tax law change that I think may have a positive effect for you. I'd like to schedule a time to go over this with you. Or Frank, I know you have that old annuity with XYZ company. Thanks to a tax law change, I may be able to enhance the benefits of your annuity. What are we talking about there? The linked benefit, life insurance, the annuity with a long-term care rider. Next slide. A couple more power phrases. Pete, I'm glad we were able to get that $500,000 of term life insurance to protect your family. I'd like to share with you a couple of features and another policy that will allow you to have access to the money while you're alive and need it. Again, a nice little power phrase to do there. And then the last power phrase is there, you can even do these applications online or over the phone. You don't have to sit there and see the people every time. So if it's a $300 term case or something along those lines, does your client have interest in doing this right over the phone? We've got programs, and a lot of the carriers allow for simplified underwriting or fillable applications that you don't have to sit to the client in person. That's the purpose of that power phrase. Let's go to the next slide. So when it comes to ideas and using life insurance or living benefits, I'm not saying you replace the existing insurance, because there's a reason why that current insurance exists. It's for buy-sell, is it for mortgage protection, income protection, whatever. But maybe it makes some sense to add a contract in addition to existing coverage. So let's go to the next slide. So maybe somebody needs $750,000 of life insurance. Does it make some sense to split it into two or three different policies? Maybe they just do $250,000 with the lowest cost term, or term with living benefits. They do $250,000 with living benefits, and so if they go on claim during their working years, and you're going to lose some death benefit if they accept the money. I've taught you that already. There's still some death benefit there. Maybe you put $250,000 or $300,000 a permanent with or without living benefits. Maybe it makes some sense to say, all right, you need $750. Let's do something with the critical illnesses here, but the permanent insurance is going to have the long-term care rider. The point is, you can do that. There's a lot of customization here and providing extra value. Let's go to the next slide. Maybe you do some life insurance and living benefits to protect the mortgage. Put some coverage on both the husband and wife, or partners have entered into a business or corporate loan. We're seeing a few of these now where a business owner has to quickly get some life insurance to help secure a loan. Well, okay, that helps. That's great if the person dies, but what if they're not deceased? If they have access to the death benefit while they're alive because they have a critical or chronic claim, that's even more valuable. Next slide. How about to provide an emergency fund? Oftentimes there's lost work for a husband and wife if somebody needs care. Think about it here. One of our colleagues that was a NAFA member a couple of years ago got diagnosed with cancer, and he eventually did pass away. But during that time he was suffering from the cancer, his wife was taking off of work, running him back and forth to the Mayo Clinic. A policy like this with living benefits, with the features that it have, could have allowed them to tap into the death benefit of life insurance early to help maintain the emergency fund or keep finances in better order than what happened to that particular couple. Next slide. How about this? And this is one where if you have an objection and you want to type it in on the forum here, I appreciate that, because I'd like to hear an objection. Many of you are helping your clients save for retirement. Your clients have IRAs, 401ks, assets under management. But if a client is seriously ill, are they going to continue to contribute? Chances are not. Or are they going to even pull money out of your accounts to help pay for their expenses? So go to the next slide. How about this for an idea? Consider at a minimum having every single one of your clients who you're helping save for retirement get a life insurance contract, even if it's term life insurance, that's equal to the length of time that gets them to retirement age. So a $250,000 policy, for example, or even $100,000, I don't care. But let's say if they're 40 years old, get them a 20 or 30-year term. If they're 50 years old, get them enough term insurance to get them to retirement age that has the living benefits. So should that critical illness hit when the client is in the accumulation phase, they're taking money from their term life insurance instead of tapping into the 401ks, IRAs, or assets under management. And even if they get a mid-range offer here, like there's a $250,000 term policy with living benefits, and they get a mid-range offer of $125,000, how helpful would that be? So I find it very difficult to find too many advisors who can give an objection to that. And you know what? If you can't come up with an objection, neither can your clients. It just makes a lot of sense. A couple more ideas real quick, and we'll wrap it up. Next slide. Consider putting life insurance with living benefits on kids or grandkids. Helps provide lifetime of protection, protects insurability, it could be cash value. It can cover them their entire life, not only for death benefit, but for critical illnesses, and even long-term care. Next slide. How about for buy-sell agreements? Lots of times businesses will have a buy-sell agreement and have life insurance to fund it, but most of the time they don't have disability funded. So I think, first of all, you should look at disability buyout insurance, but if that's not going to work, consider life insurance with living benefits that has the critical illness or the chronic illness rider. So if that partner doesn't die, but he gets disabled, or like my father did, had a stroke at 59 years old, they can tap into the death benefit of the life insurance under one of the riders, the living benefit riders, and be able to use that to help fund the buy-sell agreement. Next slide. How about the key employee? Businesses often put life insurance on a key employee whose untimely death could harm the business. But again, what if they're not dead? What if something happens to them but they are not deceased? Maybe you can take a look, tap into the life insurance with living benefits to help provide a benefit at that time. So show your business owner clients key employee, or for key man policies, life insurance with living benefits. Next slide. We're wrapping this up. I look at it this way. I mean, there's a lot of different ways that you can provide life insurance or annuities with living benefits. And I really don't find too many people that are not good candidates. Business professionals, families, grandparents on grandkids, hot women, unbelievably strong and muscular men. You know, whatever the situation may be, anybody on this slide is basically a candidate for a living benefit. Next slide. Who else is a candidate for life insurance with living benefits? And this is where you insert your face in there. So next slide. So I have got, that basically wraps it up. We're going to start taking some questions here. I've got a white paper available where I can share with you 7 different sales ideas using some life insurance with living benefits. You've got my contact information is on this slide. If you would like to have that white paper or get a little bit more information or getting some sales ideas, that type of thing, absolutely fine. Hit me up for any of the different methods here with my email or phone number, something along those lines, and we'll start taking questions. So Brandon, it's for you. Go ahead.
Yes, we have several questions already. One of them is, can I please get the slides to this presentation? And I can tell you that the recording of the webinar will be available. A web link will be emailed to all the participants where you can access the recorded webinar. In terms of slides, Mike, I'll leave that up to you if these slides are available.
I can make them available, sure. If you can do that on your end, Brandon, great. If people need to hit me up individually, I can do that as well.
Sure, we'll go ahead and email the slides out then.
Okay.
The next question, under your tab of while still alive, I saw you did not mention life settlements. Question on that.
Here's basically one of the reasons why so many companies are coming out with these living benefits is actually to compete against the settlement industry. If you remember what I was talking about here, if you go on claim and the client accepts the money, there's going to be some death benefit that's gone and not available. I've yet to see a company that's going to allow for the entire death benefit to be paid out. Now, if you have a settlement, that is basically assuring the insurance company that the entire claim is going to get paid out somehow. So if somebody sells their life insurance policy, say it's a $300,000 life insurance policy, and it's done as a settlement, the insurance company knows that they're going to be on the hook for that $300,000 because whoever bought that policy is going to keep that policy in force, and eventually whoever bought the policy has paid that insured money for that policy. So what the insurance companies have done is they've come up with these living benefits so they can offer money directly to the consumer, to their insured, on a tax-favored basis, and know that they kind of get off the hook a little bit for some of the death benefit. Hopefully that answers that question.
And we are about out of time, so we're going to wrap up with our final two questions. The first one is, can the living benefit be added to policies that are in force?
I have yet to see a company that allows that. Most of the time it's only available at issue.
Okay, and we have an objection as requested. I've had clients object to the reduced cash value shown on the illustration. It's easy to overcome, but I hear it, so more of a statement regarding that.
I'm not sure I understood what the objection was. So if that person would like to reach out to me, send me an email on my screen there and object a little more directly, I'm happy to answer that.
Excellent. We'll go ahead and make sure the two of you can get connected. And we are out of time. I want to thank you, all of the participants in today's webinar, and remind you that the archived recorded webinar will be made available with the web link emailed to all of you. And thank you, Mike, for presenting.
I will say one other thing real quick. This is also available, or a very close version of this is available in Programs in a Box. I did this for Programs in a Box a couple of years ago. It's got a lot of similar slides, and the information is slightly outdated, but it's still very relevant. So for you or your local or your state, if you want to get another opportunity to take a look at this, look at Programs in a Box.
Thanks so much, Mike. And those are available from the NAIFA Marketplace. Go to www.naifa.org, scroll down to the bottom right of the screen, and click on NAIFA Marketplace. This concludes the webinar. Have a great day.
Thank you.